Projection bias. This happens when traders assume the market is too high or too low and expect a reversal without solid evidence. The problem? The market doesn't care about your assumptions. Let me show you how this mistake plays out and, more importantly, how to avoid it. Here's how projection bias works. The market is trending up, and you identify a resistance level. You think the price is too high, it's bound to reverse here. So you enter a sell trade, expecting the market to turn around, but the market doesn't reverse. It breaks through the resistance and keeps climbing. Frustrated, you take another sell position at the next resistance level, convinced it will reverse this time. But once again, the market continues upward, and the losses pile up. The same mistake happens in a downtrend. Traders assume the market is too low and expect a bounce, entering buy trades prematurely. The market, however, breaks through support levels and keeps falling, leading to even greater losses. This isn't bad luck, it's projection bias. Traders project their personal beliefs onto the market, expecting reversals without solid evidence. The market doesn't follow your expectations, it moves based on supply, demand, and momentum. To overcome this mistake, shift your mindset. First, understand that the market is never too high or too low. Trends can extend far beyond what feels reasonable. Second, rely on evidence-based analysis. You can use tools like price action, breakouts, or candlestick patterns to validate your trades. Third, always wait for confirmation before entering a reversal trade. Look for clear signals like a shift in market structure or rejection at a key level. Remember, trading is about aligning with the market, not forcing it to fit your expectations. By avoiding projection bias, you'll make smarter, more disciplined decisions. Alright, let's dive into a mistake that's far more common than you might think, and it can happen no matter what trading style you use. So here's the situation. You're watching the charts, and you spot the perfect supply zone forming. The setup looks solid, the kind of trade that feels like a no-brainer. But then, something distracts you. Maybe you get a notification from a trading group hyping a different market, or you start scrolling through social media and see someone posting about massive gains they just made. You feel it, that itch. What if I miss this trade? You rush to place a limit order on the supply zone, assuming it's bound to work. You don't wait for confirmation. You're convinced the market will respect the zone and move in your favor. But when you check back, the frustration sets in. The trade failed. Maybe your stop loss was hit, or the market didn't react the way you expected. Here's the hard truth. This wasn't just bad luck, it was bad trading. By acting on the fear of missing out, you skipped a critical step. Confirmation. Let's be clear. The supply zone is only one part of the strategy. Who said the market must respect that zone? Trading isn't about guessing, it's about aligning all the pieces of your strategy before entering a position. If you skip steps and rush into trades, you're not trading, you're gambling. So, how do you avoid this trap? Shift your focus from fear to strategy. Opportunities are everywhere in the market. Missing one trade isn't the end of the world. Another opportunity will always come, whether in 5 minutes, an hour, or tomorrow. The market never runs out of setups. Always wait for confirmation. Whether it's a break and retest, a price action signal, or any other indicator, always ensure the market validates your zone before you commit. Confirmation isn't optional, it's essential. Trust the process. Every strategy, from supply and demand to Fibonacci retracements, works best when you follow it to the letter. Rushing a trade because of FOMO only sabotages your chances of success. Take a look at this chart. Here we have a clear range-bound market. The price breaks out of the range, pulls back, retests it, and gets rejected, forming a clean pin bar signal. You place your entry. Carefully set your stop loss just below the pin bar's lower tail and define your target. Everything looks perfect. But what happens next? The market easily hits your stop loss, only to reverse and move exactly in your favor, all the way to your target. Sound familiar? It's frustrating, isn't it? You did your analysis, identified the right setup, and yet you still lost the trade. Why? Because your stop loss was too narrow. You didn't give the trade enough room to breathe. This isn't just a technical mistake, it's a psychological one. This mistake stems from a human psychological tendency called the illusion of control bias. In trading, the illusion of control bias makes you believe that using a smaller stop loss minimizes your risk. The logic seems simple. The closer my stop loss is to my entry, the less money I'll lose. But this is an illusion. A narrow stop loss doesn't reduce risk. It increases the chances of being stopped out by normal market fluctuations, even if the trade eventually moves in your favor. Why does this mistake happen? The first reason is fear of loss. You might think that using a smaller stop loss will protect you from losing too much. But in reality, it ignores the natural volatility of the market, which needs room to breathe. The second reason is overconfidence in precision. You believe you can perfectly predict where the market will reverse, so you place your stop loss too close to your entry. This doesn't account for the normal movements of the market. And the third reason is ignoring market noise. Small price fluctuations, what we call market noise, can easily trigger a tight stop loss, even when your trade setup is still valid. Here's the truth. The distance of your stop loss doesn't determine the true risk of your trade. True risk is calculated based on 3 factors: position size, percentage of account at risk, and reward to risk ratio. Now, how do you trade this setup? You place your entry at the close of the candle that created the stop hunt, set a stop loss above the candle wick, and target the next level. Before taking the trade, always make sure the trade offers a 2-to-1 reward to risk ratio. Let's look at another example, this time at a support level. Here's the setup. The price has bounced off a strong support level multiple times, making it a clear buying zone for retail traders. Naturally, stop losses are placed just below this level to protect their positions. Now, here comes the trap. Institutions push the price just below the support level, triggering those stop losses and grabbing liquidity. The market then quickly closes back above the level. That's your confirmation. The stop hunt is done, and the institutions are ready to drive the price higher. Let's check if the trade setup on the lower time frame aligns with the higher time frame by looking at the hourly chart. As you can see on the hourly chart, the market is trending upwards. Here, the market broke a resistance level, which then became support. The price pulled back to retest this level and got rejected, indicating that the market is likely to make another move upwards. This confirms that the higher time frame aligns with our trade setup signal on the lower time frame. Now, let's return to the 5-minute chart. Here's how you trade it. Place your buy entry at the close of the candle that created the false breakout at the support level. Set your stop loss just below the support level. Target the next resistance level, ensuring at least a 2-to-1 reward to risk ratio.